There's a peculiar allure in the word cheap. For investors, it often feels like a secret door to profit, a chance to buy what everyone else overlooks and later enjoy the thrill of being proven right. But as Benjamin Graham warned time and again, cheapness can be one of the most dangerous illusions in investing. When markets fall, when fear dominates the headlines, investors naturally begin hunting for bargains. They scan for the lowest price-to-earnings ratios, the deepest discounts to book value, the stocks that seem to have nowhere to go but up. It feels sensible, even prudent. After all, isn't value investing about finding underpriced assets? Graham once believed that too. In fact, early in his career, he built his reputation on the notion that you could safely profit from the market's mistakes simply by buying what was statistically cheap. His logic was simple. If you could buy $1's worth of assets for 50 cents, the odds were in your favor. And for a while, it worked. It worked beautifully. But beneath those tempting numbers lurked something deeper, something the arithmetic could not reveal. Many of the companies that looked cheap on paper were not undervalued, they were dying. Their low price wasn't an opportunity, it was a warning. That realization would come to Graham not from theory, but from painful experience. He would see firsthand how companies that appeared sound on the balance sheet could still collapse, wiping out investors who thought they were being cautious. It was a revelation that reshaped his entire philosophy, that cheapness alone cannot protect the investor. Because a low price doesn't guarantee a good investment. It merely guarantees that you paid less for whatever risk you're taking. In this story, we'll trace how Graham's understanding evolved, from chasing statistical bargains to defining true value as something far deeper than numbers alone. We'll look at the traps he fell into, the lessons he drew from them, and how those lessons remain just as urgent today. Because while technology has changed and markets have evolved, human nature has not. Investors still mistake low price for safety, just as they did in Graham's time, and many still pay dearly for that mistake. But Graham's journey offers us a guide, a map, out of the illusion of cheapness toward a disciplined, enduring approach to finding real value. And it all began during a time when the world of finance itself was collapsing, the Great Depression. A period that would test every idea Graham ever had about what made a stock safe. But as we'll soon see, the very principles he built his career on would be challenged and transformed by the brutal lessons of the 1930s. In the aftermath of the 1929 market crash, Wall Street was a wasteland. Stocks that once traded for hundreds of dollars now sold for mere cents. Fortunes had vanished, and the idea of investing itself seemed reckless. Yet in that rubble, Graham saw opportunity. He wasn't guided by emotion or speculation. He was guided by numbers, cold, hard arithmetic. If a company's assets, when liquidated, were worth more than its stock price, then surely, Graham reasoned, it was a bargain. This method became the foundation of what we now call deep value investing. He scoured financial statements line by line, looking for companies trading below their net current asset value, that is, what would be left if the business shut down tomorrow, paid off all its debts, and sold everything it owned. If he could buy that dollar of value for 50 cents, he believed he couldn't lose. And for a while, that belief held true. Graham earned impressive returns throughout the early 1930s, even as the broader market remained battered. He and his firm bought into forgotten stocks, railroads, industrial suppliers, small manufacturers, all priced for collapse. One of his most famous early triumphs was his investment in Northern Pipeline. The company was selling far below the value of its liquid assets, a situation the market had completely ignored. When the value was eventually recognized, Graham made a substantial profit. It was the perfect vindication of his numerical approach. In those years, his investing could be summarized in a single principle: find what is statistically cheap, buy it, and wait for the market to come to its senses. The beauty of this method was in its simplicity. It didn't require predicting the future, studying management, or guessing which industries would thrive. It only required discipline, the discipline to buy what others feared. But this method also carried an unseen flaw, one that only time would expose. Many of the stocks Graham bought were indeed cheap, but not because the market had mispriced them. They were cheap because their businesses were deteriorating. Their assets were overstated, their products obsolete, and their industries in decline. It was a subtle but crucial distinction. Some stocks were undervalued, others were rightly devalued. The numbers looked the same, but the reality behind them could not have been more different. And Graham, like every investor learning the limits of a theory, would come to understand this difference not in a classroom, but in the harsh light of experience. Because in the years that followed, many of those bargains, those supposedly low-risk, high-value plays, would vanish. Bankruptcies, liquidations, and endless restructuring became the graveyard of what once seemed like mathematical certainties. For Graham, this was more than a financial setback. It was an intellectual awakening. He began to see that numbers could lie, not intentionally, but subtly. That the comforting precision of balance sheets often masked the chaos of the real world. And as those cheap stocks crumbled, Graham was forced to confront a painful truth. Sometimes the greatest danger to an investor isn't overpaying for quality, it's underpaying for failure. That realization would mark a turning point, because the next phase of his journey wasn't about finding bargains. It was about understanding why some bargains were traps. And that understanding began with failure. The market has a way of humbling even the sharpest minds, and for Graham, humility came disguised as opportunity. He once said that the investor's worst enemy is not the market, but himself, his eagerness to find certainty when none exists. Throughout the 1930s, Graham had been confident in his methods. His spreadsheets, his calculations, his meticulous balance sheet analyses all pointed to safety. Yet one by one, some of his most safest investments began to collapse. There was a pattern to these failures. Many of the companies he purchased had looked sound on paper, trading far below their book value. They owned factories, inventory, and machinery, tangible assets that, in theory, protected investors from loss. But what those numbers didn't reveal was how quickly those assets could lose relevance. In an industrial economy still reeling from the Depression, entire sectors were being reshaped. Demand was evaporating, technology was changing, and once dominant firms were slowly bleeding cash. The machines listed on the balance sheet as valuable assets had in reality become little more than scrap metal. Graham learned that a company could be cheap for years and still destroy capital.
Through those hard lessons, Graham began to see the true value wasn't found in accounting tables alone. It lived in the health of the business itself, its capacity to endure and adapt. He wrote later that the investor must never mistake a cheap stock for a sound investment. Cheapness, he realized, is a reflection of the past, of declining profits, fading relevance, or failing confidence. Value, on the other hand, is a reflection of the future, of a company's ability to sustain itself and reward shareholders over time. The distinction seems obvious now, but at the time it was revolutionary. It marked the moment Graham began to separate price from quality. He started to ask new questions. How stable are the earnings? Is management prudent? Is the company's financial structure strong enough to survive downturns? These were questions his early formulas could not answer. They required judgment, context, and perspective. And in that shift, from blind arithmetic to intelligent analysis, Graham was quietly redefining what value investing truly meant. But perhaps the most powerful insight came not from the failures themselves, but from what they revealed about investor psychology. Because even as he was learning these lessons, others continued to repeat the same mistakes. Rushing toward cheapness, confusing low prices with low risk. It's a pattern we still see today. In every bear market, investors scoop up beaten-down stocks, convinced that they can't go any lower. Some of those bets pay off, but many end in quiet, painful losses. Graham's experiences in those turbulent years became a warning that has echoed across generations. A low price is not a cushion. It's a test, one that only true value can withstand. And from the ruins of those failed bargains, Graham's philosophy began to evolve. He would move beyond the safety of spreadsheets and into a new realm, one where judgment mattered as much as mathematics. It was time for Graham to redefine what value really meant. By the mid-1930s, the financial world was beginning to recover, and so was Graham's philosophy. The man who once trusted numbers above all else had come to understand that investing required more than arithmetic. It required discernment. He began to see that not all value could be measured in columns and ratios. A company's true worth depended on its quality, the durability of its business, the honesty of its management, and the consistency of its earnings. These were things a balance sheet could not fully capture. This realization marked a quiet revolution in his thinking. Graham still valued numbers. He would always remain a man of discipline and logic. But now he viewed them as a starting point, not an answer. He began to combine his quantitative rigor with qualitative judgment. A company might be statistically cheap, yes, but was it sound? Was its business model viable? Could it weather the next economic storm? These deeper layers of analysis changed everything. For example, in the years that followed, Graham began studying firms with consistent profitability and conservative financing. Businesses that might not be the cheapest by traditional measures, but were stable and well-managed. These companies offered what he began to call defensive value, investments that protected both capital and peace of mind. He noticed that such companies, though rarely dramatic in their performance, often outlasted the speculative favorites of the day. They didn't just survive downturns, they emerged stronger. It was around this time that Graham's focus shifted from finding the cheapest stock to finding the soundest enterprise at a reasonable price. The shift may sound subtle, but it represented a profound evolution, one that would eventually shape the philosophy of his most famous student, Warren Buffett. Buffett would later summarize this evolution perfectly. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. That idea, though famously quoted by Buffett, was born from Graham's own transformation.
In Graham's earlier years, he might have dismissed the notion of paying more for quality as speculation. But after enduring the consequences of cheapness without substance, he recognized that quality itself was a form of value. He wrote that the risk of paying too high a price for a good company is less than the risk of paying too low a price for a bad one. That was his mature philosophy, value, redefined not by how little you pay, but by how much you actually get for what you pay. This concept resonates powerfully even today. In a world overflowing with data, ratios, and metrics, many investors still cling to the illusion that precision equals safety. Yet, as Graham discovered nearly a century ago, safety comes from judgment, from understanding the business behind the numbers. Still, this transformation didn't happen overnight. It required Graham to unlearn his earlier habits and question his own success. And that's what makes this chapter of his story so timeless. The humility to evolve, to admit that even the right formula can be wrong if applied without context. But Graham's evolution wasn't just philosophical, it was practical. He began to abandon some of the very strategies that had made him famous. The next phase of his journey would mark a decisive break from his past, the moment he turned away from cigar butt investing, those cheap, declining companies that offered one last puff of profit before they went out. Because Graham had finally learned that a dying business, no matter how cheap, is not a bargain, it's a trap disguised as one. And this decision would not only reshape his own approach, but redefine value investing for generations to come. By the late 1940s, Graham had become one of the most respected voices on Wall Street. His methods were studied, his books widely read, and his principles had rescued countless investors from the chaos of speculation. Yet beneath that success lay a surprising realization. Graham was quietly moving away from the very strategy that had once defined his career. He began to see that the cigar butt approach, while brilliant in theory, was limited in practice. It was built for a certain kind of market, one that no longer existed in the same form. In the aftermath of the Great Depression, the stock market had been filled with neglected, asset-rich companies selling for next to nothing. For a disciplined analyst, bargains were everywhere. But as markets matured and transparency improved, those deeply discounted opportunities became rarer. The easy wins from statistical cheapness were disappearing. Worse, the remaining bargains often came from businesses in irreversible decline. Broken models, outdated industries, companies drowning in debt. In his own words, Graham admitted that cigar butt investing could still work, but it demanded immense patience and diversification. You might need to own dozens, even hundreds of small, forgotten companies just to balance out the inevitable failures. It was a strategy for scavengers, not for builders. So Graham began to evolve again. Instead of hunting for remnants of dying businesses, he turned his focus towards companies with solid fundamentals, stable earnings, conservative financing, and a long record of treating shareholders fairly. He realized that the real power of investing wasn't in chasing the lowest price, but in aligning with enduring value. He began to appreciate that time could become an ally, not an enemy, when invested in sound enterprises. This shift is beautifully illustrated in how he approached his later work, particularly in The Intelligent Investor. Here, Graham emphasized not just buying undervalued stocks, but buying well-founded businesses at prices that provided a margin of safety. He taught that a sound investment must have both value and stability. Cheapness alone was not enough.
It was an extraordinary change for a man once known for mining the market scraps, yet it showed his greatest strength, intellectual honesty. He had the courage to outgrow his own success, to admit that what once worked brilliantly might no longer serve investors in a changing world. And in that honesty lies one of Graham's most enduring lessons. The investor must evolve, just as the markets do. The principles of discipline, margin of safety, and rationality never change, but the ways they are applied must. For Graham, the move away from cigar butts was more than a strategic adjustment. It was a moral one. He no longer wished to profit from the decay of broken companies. He sought instead to invest in resilience, in enterprise, in the kind of businesses that built rather than crumbled. This evolution, however, also led to one of his most profound warnings, a message often forgotten in the noise of bull markets and speculative manias. Because as Graham began teaching his students in the post-war years, he noticed that many still clung to the same dangerous assumption that had once misled him, the belief that low prices automatically mean low risk. But Graham knew better now. He had lived through the deception of cheapness, and he understood its cost. And so he began to warn investors, not against expensive stocks, but against illusory safety. Because, as he would often say, a stock is not cheap merely because it has declined. That warning remains as urgent today as it was then, and it forms the heart of Graham's greatest insight. the illusion of safety in low prices. Graham's later writings carry a tone that is unmistakably cautious, not fearful, but deeply aware of human nature. He understood that investors, no matter how intelligent, are always vulnerable to a particular kind of illusion. The belief that buying something cheap automatically makes it safe. He saw it happen in every cycle. When markets fall and optimism vanishes, investors begin searching for comfort in numbers. They look at a stock trading at a fraction of its former price and say, "It's already down so much, it must be a bargain." They see a low price-to-earnings ratio or a steep discount to book value and feel protected, as if mathematics alone could guarantee safety. But Graham warned that this feeling is deceptive. A low price can just as easily signal danger. Sometimes a stock is cheap because its business is weak, its management reckless, or its industry in decline. Cheapness can be the market's way of shouting, "Something is wrong here." He wrote that the chief losses to investors come from purchasing low-quality securities at times of favorable business conditions. In other words, risk often hides in what looks least risky, in the comfortable belief that it can't get any worse. And yet, it can. Think of the modern parallels. In every bear market, we see investors rushing to buy companies whose share prices have fallen 80 or 90%, convinced that the rebound is inevitable. During the 2008 financial crisis, countless bargains in banking and real estate turned out to be traps. In the 2020 pandemic crash, many companies looked cheap but were structurally unfit for the new economic reality. Graham would have recognized these patterns instantly. His warning wasn't against taking risk, it was against misunderstanding it. The danger is not in volatility itself, but in confusing decline with opportunity. He taught that safety in investing comes not from price, but from soundness. A company that earns stable profits, carries modest debt, and operates in a healthy industry is safer at a fair price than a struggling business selling at a deep discount.
To Graham, the essence of intelligent investing was simple. Never let low prices replace good judgment. Numbers are tools, not answers. They must be interpreted in the context of reality, of business quality, management integrity, and long-term sustainability. He often reminded his students that a stock certificate is not a lottery ticket or a piece of paper that magically regains its value once the market improves. It is a fractional ownership in a real business. And if that business deteriorates, no amount of cheapness can save it. In this sense, Graham's greatest warning wasn't mathematical, it was psychological. The human mind craves certainty. It wants to believe that by buying cheap, it has reduced risk. But in truth, the opposite is often the case. Low prices without substance magnify risk because they lure investors into complacency. He saw this trap destroy fortunes in his lifetime, and he knew it would continue to do so as long as investors mistook price for value. That's why he urged investors to anchor themselves not in emotion or appearances, but in principles, in the steady discipline of analysis, patience, and skepticism. It was this balance between caution and conviction that defined Graham's mature philosophy, and it led him to his final, enduring message, that the investor's true protection lies not in cheapness, but in understanding, in knowing what he owns and why. And that brings us to the last and most important lesson of all, what real value looks like and how Graham's evolved wisdom can still guide investors in the uncertain markets of today. By the time Graham published the final editions of The Intelligent Investor, his philosophy had reached a kind of calm clarity, the distilled wisdom of decades spent observing markets rise and fall, and investors repeat the same mistakes through every era. He no longer chased the illusion of precision or the comfort of cheapness. Instead, he defined value in the simplest, most profound way. True value is that which endures. To Graham, a sound investment combined three essential traits: understanding, quality, and margin of safety. These, he believed, were the pillars of lasting success. Understanding meant seeing beyond numbers, knowing the business, its industry, its vulnerabilities, and its potential. It meant treating every stock as a share in a real enterprise, not a fluctuating ticker symbol. Quality meant owning businesses that could survive hard times, companies with honest management, consistent earnings, and conservative finances. These were the enterprises that didn't just look good in bone markets, but remained standing when the cycle turned. And margin of safety, perhaps his most enduring contribution, meant always allowing room for error. No matter how confident the investor feels, uncertainty is constant. The margin of safety isn't about predicting the future, it's about preparing for it. Through this lens, cheapness became almost irrelevant. A stock priced low might offer no safety if its future was uncertain, while a fairly priced company could offer enormous safety if its fundamentals were strong. He wrote that the function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. In other words, investors don't need to predict, they need to protect. For modern investors, these lessons are more vital than ever. Markets today move at lightning speed, driven by data, algorithms, and sentiment. The temptation to equate low prices with opportunity is just as strong, perhaps stronger than it was in Graham's time, but the principles remain unchanged. First, study the business, not the ticker. Numbers are only as useful as the understanding that interprets them. Second, demand both value and quality. A low price without quality is speculation, not investment.
Third, always build a margin of safety, not just in price, but in judgment. Expect to be wrong sometimes, and structure your decisions so that being wrong doesn't destroy you. These are not complicated ideas, but they require discipline, the kind of discipline that comes from humility and patience. Graham embodied both. He understood that the market will always be emotional, swinging between optimism and despair. Prices will soar, collapse, and recover again. But beneath those waves, value remains, steady, rational, enduring. And perhaps that is why his teachings have survived every crash and every bull run since his time. They speak to something deeper than finance. They speak to temperament, to the ability to remain calm, rational, and independent in a world that constantly tempts us to follow the crowd. Graham's life is proof that wisdom is not born from success alone, but from reflection, from learning what not to do as much as what to do. He once wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself." And that is the ultimate warning behind the lesson of cheap stocks. The danger isn't just in the market, it's in our instincts, our eagerness to find certainty, to chase bargains, to believe that safety lies in numbers rather than understanding. But the investor who internalizes Graham's lessons gains something far greater than profits. He gains peace, the confidence that comes from knowing why he invests, what he owns, and how to think when others are losing their way. In the end, Graham didn't just teach how to invest, he taught how to think about investing. His wisdom turned speculation into discipline, chaos into clarity, and fear into opportunity. Because true value, as Graham showed us, is not found in price tags or spreadsheets.
It's found in sound judgment, patient temperament, and the quiet strength to act rationally when the world does not. And that is why nearly a century later, Benjamin Graham's warning still stands. Cheap stocks can destroy capital, but intelligent investing can build it, quietly and lastingly, through every storm. The markets may change, but wisdom does not. And in that timeless wisdom lies the path to true, enduring value.